Hey everyone, and welcome back to Safe Simple Sound. I'm your host, Alex, and I'm really glad you're tuning in today because we're tackling a topic that's incredibly important but often flies under the radar for so many Americans. Today's episode is based on our article on safesimple.sound.com. The core of this article and our discussion today is all about foreign financial reporting for U.S. persons. It shines a light on how many of us might have financial connections abroad, maybe an old bank account, an inheritance, or a gift from family overseas, and be completely unaware of the complex U.S. reporting requirements that come with them. A couple of things from that article really stood out to me and are crucial for our listeners, especially our target audience of U.S. citizens, green card holders, and tax residents who might be feeling a bit lost in this area. First, those seemingly innocent financial situations, like your parents sending you money from Canada for a house down payment, can trigger significant reporting obligations. Second, while having these foreign ties is perfectly legal, not reporting them correctly can lead to some truly eye-watering IRS foreign account penalties. We're talking potential fines exceeding $30,000. But here's the good news the article stresses, and what we believe in here. With the right approach, these penalties are entirely avoidable, and peace of mind is achievable. If you're a U.S. person with any financial connections outside the United States, or even if you just think you might, this episode is designed to bring clarity and actionable insights. So, grab a coffee, settle in, and let's make sense of foreign financial reporting. I call it the oops moment, that sudden realization that you might have hidden foreign financial reporting needs. It's more common than you think, and definitely something every American with international ties should be aware of. So, what's this oops moment all about? Well, here's the thing. Many U.S. persons, and that includes citizens, green card holders, and even folks considered U.S. residents for tax purposes, have financial connections outside the United States. Maybe you lived abroad for a few years and still have a bank account there that you barely think about. Perhaps your wonderful aunt in Italy or your parents back in India occasionally send you money, or you inherited a small property overseas. These connections are a normal part of our increasingly global lives. But what often happens is that people are completely, and I mean completely, surprised to learn about the sometimes complex U.S. reporting requirements that come with them. It's like finding an old lottery ticket in a jacket pocket. Exciting, but this one might come with some unexpected homework. And this leads us straight into my first key point. These revelations often stem from the most innocent-sounding questions. Someone might casually ask, "Oh, by the way, do I need to mention that account I still have in India? It's got about 20 lakhs in it from my family business, but it's just sitting there." Or, "My parents sent me $150,000 from their Canadian account to help with a house down payment." That's just family money, right? No need to report that, is there? These sound like perfectly reasonable everyday financial situations, don't they? But here's the kicker. Each of those casual mentions can immediately signal potentially significant compliance obligations. That family money or that old account could trigger the need to file specific forms with the U.S. government. It's a classic example of how what seems minor can be a really big deal. Why do you think so many Americans with international connections are caught off guard by these reporting rules? I think a big part of it is that these rules aren't always front-page news. And sometimes there's a misconception that if money isn't directly U.S. income, it doesn't need U.S. attention. Now, this brings me to a really crucial point. The U.S. government has significantly, and I mean significantly, increased its focus on foreign financial reporting, especially over the past decade or so. What used to be a simple yes-no tick box on a tax return has evolved. The potential penalties for errors or omissions, they can be steep, folks. We're talking penalties that can easily exceed $30,000 for what might seem like an oversight. So, what might appear as a minor detail about an overseas account can actually be a crucial issue for foreign account reporting U.S. The landscape has definitely changed. Global information sharing between countries is up, and the IRS has more tools than ever to identify unreported foreign assets. This isn't about trying to scare anyone, but it is about highlighting why this is more critical than ever. But here's some good news. And it's really important to hear this. It is perfectly legal for Americans to have foreign bank accounts, investments, or receive gifts from family abroad. Absolutely. The real challenge isn't the financial tie itself. The challenge lies in knowing what needs to be reported, when it needs to be reported, and how to report it correctly. This includes details related to U.S. tax foreign income, even if that income isn't taxed in the same way as your U.S. salary, and of course, the assets themselves. The government isn't saying you can't have these connections. They're saying we need to know about them. So as we're talking through this, I want you to take a moment and just reflect. Think about your own financial life. Have you ever lived or worked outside the U.S.? Do you have family in other countries who might have set up accounts for you or from whom you've received financial gifts? Do you own a share in a family business overseas, however small? It's these seemingly small connections that can often lead to that oops moment we're discussing. Let's quickly recap what we've covered in this segment. First, many U.S. individuals have foreign financial ties they might not realize have U.S. reporting requirements. Second, even casual, innocent-sounding questions about these foreign connections can unveil significant compliance duties. Third, the U.S. government's focus on foreign account reporting U.S. has intensified, and penalties for non-compliance can be substantial. And finally, and most reassuringly, owning foreign assets or having overseas financial ties is perfectly legal. The hurdle is understanding and fulfilling the reporting obligations for things like U.S. tax foreign income and foreign assets. I really encourage you to reflect on your own financial situation. Ask yourself, do you have any financial accounts, assets, or connections outside the U.S., no matter how insignificant they might seem right now? This initial thought, this simple question you ask yourself, is truly the first step towards clarity and peace of mind. So now that we understand how these situations can arise, let's get down to brass tacks. We're focusing on what triggers reporting, common foreign assets you must declare. We're going to break down the most frequent scenarios that tell the IRS and other government agencies, hey, I have some financial interests outside the U.S. All right, first up, and perhaps the most common trigger, are foreign bank accounts. This means any account you hold outside the U.S. Could be a simple checking or savings account, maybe an investment account. Now, the big keyword here, and one you'll hear a lot, is FBAR requirements. FBAR stands for Report of Foreign Bank and Financial Accounts. The key threshold that often gets people's attention is $10,000. But here's a super important detail and a common misunderstanding. That $10,000 isn't per account. It's the total value of all your foreign accounts combined, if that total hits $10,000 at any point during the calendar year. So if you have $3,000 in an account in Canada, $5,000 in one in the UK, and $2,500 in one in France, boom, you've crossed the $10,000 aggregate and the FBAR likely applies to you. This even includes accounts you thought were closed, but still had a little bit of money lingering in them for part of the year. So that account from your study abroad days in Spain, if it had a balance, it counts towards that total. Next, let's talk about money or property coming to you from overseas. This is where gifts or inheritances from abroad come into play. If you receive a significant amount of money or property from someone who isn't a U.S. citizen or resident, this usually needs to be disclosed. We're generally talking about gifts over $100,000 from foreign individuals. And yes, even perfectly legitimate, loving family gifts require foreign gift reporting U.S. Now, a question I often get is, why does the U.S. government care about a gift from my aunt in Germany if it's not even taxable to me here? That's a great question. It's less about trying to tax the gift itself when you receive it, and more about financial transparency. The government is interested in understanding large movements of money across borders, partly to ensure the source of the funds is legitimate and to track assets that might generate future taxable income for you. So that generous $150,000 wedding gift from your parents living in India? Wonderful, but it very likely needs to be reported. Moving on, what if you own a piece of a business located outside the U.S.? This brings us to foreign business ownership. If you own a part of any business entity based outside the U.S., this often necessitates reporting. Typically, we're looking at an ownership stake of 10% or more. This includes investments that might seem pretty minor on the surface, but still cross these foreign business reporting thresholds. And it's not always straightforward. Someone might indirectly own a foreign asset and not even realize they have a reporting duty. For instance, perhaps you're a beneficiary of a family trust set up abroad, and that trust holds shares in a foreign company. Or maybe you inherited a 12% stake in your cousin's small tech startup in Ireland years ago. Even if it's not paying you dividends yet, that ownership interest itself could trigger a need to report foreign assets to IRS. It's about the interest, not just the immediate cash flow. And finally, there's a broader category we can call other foreign financial assets. This is a bit of a catch-all, but it's crucial. It includes things like foreign stocks or bonds that you hold directly, not through a U.S. brokerage account, already doing some reporting for you. Financial contracts you might have with foreign entities, or interests in foreign partnerships or trusts that don't quite fit the business ownership category we just discussed. The overarching principle here is the U.S. government's interest in ensuring comprehensive foreign financial reporting. So, if you directly purchase shares on, say, the Australian Stock Exchange, or you have a note receivable from a company in Brazil, these are the kinds of assets that fall under this umbrella. The core idea is the need to report foreign assets to IRS if they meet certain criteria. Phew. Okay, that was a lot, I know. We've covered foreign bank accounts and the crucial FBAR requirements, those significant gifts or inheritances from abroad that need foreign gift reporting US, owning a slice of a foreign business reporting needing company, and that broader category of other assets where you need to report foreign assets to IRS. Does any of this make you pause and think? Do any of these categories, an old savings account, a generous gift, a small share in a family business overseas, or some stocks you bought directly on a foreign exchange, resonate with your own financial life? To sum up, the main triggers for foreign asset reporting often involve 1. Foreign bank accounts with an aggregate balance over $10,000. 2. Significant gifts or inheritances from non-U.S. persons, often over $100,000. 3. Ownership of 10% or more in a foreign business. 4. Other foreign financial assets like directly held stocks, bonds, or certain contracts. The key here is awareness and then action. So, here's your call to action for this segment. Something practical you can do. Take inventory of your global financial footprint. Seriously, grab a piece of paper, open a new note on your phone, whatever works for you. List out any bank accounts you have outside the US. Think about any significant gifts or inheritances you've received from family or others abroad. Do you have any business interests, even small ones, in companies based overseas? What about other investments held directly with foreign institutions? Make a note of their approximate values. The goal here isn't to file anything immediately, but to paint a clear picture for yourself and see if any of these might be approaching those common reporting thresholds we've discussed. This initial inventory is such a powerful first step towards clarity and peace of mind when it comes to U.S. tax foreign income and asset reporting. Now, once you've identified that you might have something to report, the next question that naturally pops up is, okay, Alex, what now? How many forms are we talking about here? Who do I send them to? And why does this all seem so complicated? And trust me, you're not alone in feeling that way. It can feel a bit like navigating a maze. Next, we're diving headfirst into navigating the maze, why foreign reporting is so confusing. We're going to break down the common culprits, the multiple forms, the different government agencies, those ever-shifting thresholds, and of course, the deadlines. It's a lot, I know, but stick with me, because understanding this landscape is key to staying compliant and avoiding some pretty hefty headaches. You know, it often makes me wonder, why did the system evolve to be this complex with multiple forms and various government agencies involved in foreign financial reporting? While we might not solve that philosophical question today, we can get a handle on what it means for us. So let's tackle the first big point of confusion. It's what I call the multiple form reality. Think about this. You might have one single foreign bank account or one specific foreign investment. Easy, right? You report it once and you're done. Unfortunately, not always. That same single account or asset might need to be reported on several different forms. For instance, there are questions on your main income tax return. Then there's the well-known FBAR, which is officially FinCEN Form 114. And on top of that, you might also need to complete a Form 8938 filing, which is the Statement of Specified Foreign Financial Assets. It's easy to think, isn't this redundant? Am I just telling them the same thing 3 times? But the truth is, these forms are not redundant. Each one serves a distinct purpose for the overall picture of foreign financial reporting. It's like when you buy a house. You have paperwork for the loan, paperwork for the title, paperwork for insurance. Different documents, all related to the same house, but serving different legal and practical functions. Now, adding another layer to this maze is my second point: different agencies, different rules. It's not just multiple forms, it's that these key forms often don't even go to the same place. For example, that Form 8938 we just mentioned, that gets filed with the IRS, typically along with your tax return. But the FBAR, or FinCEN Form 114, that's a different story. It's filed with FinCEN, the Financial Crimes Enforcement Network, which is actually a bureau of the U.S. Treasury. So you've got the IRS looking at one piece for tax compliance and FinCEN looking at another for different regulatory reasons. It's like needing a driver's license from the DMV, but a parking permit from your city council. 2 different government bodies, both interested in your car, but for different reasons and with their own set of rules. This brings us to the third tricky part: varying thresholds and definitions. This is often where people get really tangled up. Each form, FBAR, Form 8938, and others, has its own specific dollar amount that triggers whether or not you need to file it. And to make it even more interesting, these thresholds can change based on your tax filing status, whether you're single, married, filing jointly, and so on. For example, the FBAR generally has a $10,000 aggregate threshold. That means if the total highest value of all your foreign accounts combined exceeded $10,000 at any point during the year, you're likely on the hook. But for Form 8938 filing, the thresholds for reporting specified foreign financial assets are generally much higher and depend significantly on your filing status and whether you live in the U.S. or abroad. This is where understanding the Form 8938 versus FBAR differences becomes absolutely critical. It's not an either-or. You might need to file one, both, or neither. I often hear people ask, what is the most common point of confusion people encounter when trying to differentiate between FBAR and Form 8938 obligations? And honestly, it's often these differing thresholds and the fact that they are looking at slightly different pools of assets. And finally, point number 4, which can trip up even the most organized folks: timing is everything. You'd think if one form is tied to your tax return, they'd all be due at the same time, right? Not necessarily. Some forms, like Form 8938, are indeed due with your income tax return, including extensions. But others, most notably the FBAR, FinCEN Form 114, have their own specific deadlines. For years, the FBAR had a June 30th deadline with no extensions, but now it aligns more with the tax filing deadline, including an automatic extension. However, it's still filed separately. Missing these deadlines isn't just a minor oversight, it can lead to significant IRS foreign account penalties. And trust me, those are penalties you really want to avoid. So, just to quickly recap the maze's main obstacles: 1, multiple form reality; 1 asset, potentially many forms; 2, different agencies, different rules. Forms go to separate government bodies like the IRS and FinCEN. 3, varying thresholds. Each form has unique dollar triggers, often status dependent. 4, timing is everything. Different forms can have different due dates, and missing them is costly. Phew, I know that's a lot to absorb. You might be thinking, given all these varying deadlines and thresholds, what strategies can anyone possibly use to stay organized and ensure timely compliance? That's a fantastic question, and it really leads into our call to action for this segment. The big takeaway here is to acknowledge the potential complexity. If you have foreign accounts, foreign investments, received a large gift from overseas, or own part of a foreign business, please don't assume that checking one box on your tax return or filing one form covers everything. The landscape of foreign account reporting US is intricate. So, my call to action for you today is this. If anything we've discussed resonates with your situation, it is so wise to do some further research, or even better, seek advice from a qualified professional. They can help you understand all the specific forms, the relevant agencies, the exact thresholds that apply to your unique situation, and crucially, all the deadlines. Don't let the maze intimidate you into inaction. We've just waded through the often murky waters of why foreign reporting can feel like such a maze. All those different forms, agencies, and thresholds we talked about in the last segment. It's enough to make your head spin, right? But the fantastic news is there's absolutely a clear path through it, and that's what we're diving into now. Now, we're focusing on finding peace of mind, the professional approach to compliance, and your next steps. Because ultimately, that's what this journey is all about. Not just ticking boxes on some form, but feeling genuinely secure and confident about your financial affairs, especially when they cross international borders. So, let's talk about the goal here. The first thing I want to really emphasize is that the primary aim of addressing foreign financial reporting isn't about going on a witch hunt for problems or trying to uncover some hidden issue. Far from it. It's actually all about achieving complete international tax compliance US. And why is that so critical? Well, of course, there's the very practical side of avoiding unnecessary stress and those potentially severe penalties we've touched on. But think bigger for a moment. Beyond just avoiding the stick, what are the broader benefits? When your foreign financial reporting is accurate and up to date, you gain this incredible sense of peace. You're not constantly looking over your shoulder or worrying if you missed something. You can actually focus on your financial goals, on your family's security, and on living your life without that nagging uncertainty. Now, you might be wondering, okay, Alex, peace of mind sounds great, but how do we actually get there when it all feels so complicated? This is where a professional, methodical approach makes all the difference. When I work with clients on this, we don't start by throwing a textbook of regulations at you. It usually begins with very simple, broad questions in everyday language. Something like, do you have any financial connections outside the US? This could be anything. Maybe an old bank account from when you studied abroad, a gift from your beloved aunt who lives overseas, or perhaps you own a small share in a family business in another country. It's like peeling an onion, layer by layer. We start broad, and then, from that initial, simple conversation, we conduct a systematic review of each area. This ensures nothing important falls through the cracks. And this, right here, is how working with a qualified professional, perhaps a chartered financial consultant CHFC, a CFP professional, or an enrolled agent EA, can really demystify these complex rules. They are experts at taking that knot of anxiety, that feeling of being completely overwhelmed by forms and deadlines, and transforming it into a clear, manageable action plan. It's about bringing clarity to what seems like chaos. And believe me, it's a huge relief for so many people. This leads to a really crucial takeaway I want everyone listening to absorb. Having foreign financial ties doesn't automatically create tax problems. Let me say that again. Having an account in another country, receiving an inheritance from abroad, or owning a piece of a foreign business, these things in themselves are not the issue. It's perfectly legal. The challenge, and where complications and potential penalties can arise, is from the failure to report them properly. That's the distinction. And yes, the rules can be complex. I won't sugarcoat that. The regulations around when you need to file an FBAR or a Form 8938 can seem daunting, but the key thing to remember is that they are manageable with proper guidance. When you truly understand your obligations, what needs to be reported, to whom, and by when, it's incredibly empowering. You can meet these requirements confidently. And again, this frees you up mentally and emotionally to concentrate on what truly matters: your financial goals, building that secure future for your family, and not being bogged down by compliance fears. So, if you're listening to this and a little light bulb has gone off in your head, if you're thinking, I might have some of those unreported foreign financial ties Alex is talking about, please don't panic. The very first practical step you should consider taking is to get organized. And a fantastic, actionable way to do this is to use a comprehensive foreign financial reporting checklist. We use this as a starting point. It's designed to help you systematically review your own situation, identify those potential reporting needs you might not have even been aware of, and it really helps you prepare for a productive discussion with a financial advisor for U.S. foreign financial reporting. It's about taking that first informed, proactive step. So let's quickly recap the key takeaways from this segment. First, the main goal here is achieving peace of mind through complete international tax compliance US. It's about assurance, not accusation. Second, a professional, systematic approach, often starting with simple questions, makes navigating these rules manageable. Third, remember, having foreign financial ties isn't inherently a problem. It's the failure to report them properly that can lead to complications. And finally, while the rules are complex, they are definitely manageable with the right guidance and tools, empowering you to focus on your life and goals. An actionable first step is often using a checklist to assess your situation. Now, if this discussion has raised questions about your own situation, take a proactive step towards clarity. Seek out a comprehensive checklist or consider consulting with a qualified financial professional to gain peace of mind regarding your foreign financial reporting obligations. Many, like myself, offer resources such as a free checklist to get you started. Taking that step can truly make all the difference. It's all about making your financial life simpler and more secure. And that brings us to the end of today's deep dive into the often murky waters of U.S. foreign financial reporting. Phew, we covered a lot of ground, but my hope is that this discussion has brought some real clarity to what can feel like a very complex topic. Today, we walk through the entire journey, from that sudden oops moment when you might discover hidden reporting needs for your foreign account reporting US, to understanding exactly what triggers reporting, whether it's foreign bank accounts and those critical FBAR requirements, or the specifics around foreign gift reporting US and even foreign business reporting. We also navigated that confusing maze of forms and agencies, trying to demystify things like the FinCEN Form 1114 versus the IRS Form 8938 filing. And most importantly, we talked about finding peace of mind, how achieving full international tax compliance US is the ultimate goal, allowing you to sidestep those daunting IRS foreign account penalties and manage your US tax foreign income and assets correctly. The biggest takeaway, as highlighted in the article that inspired this episode, is that having foreign financial ties is perfectly fine. It's the failure to report them accurately that can cause problems. It's all about knowing your obligations to report foreign assets to IRS, including when you need to report foreign bank account IRS. This journey into foreign financial reporting truly aligns with our mission here at Safe Simple Sound, to help you seize financial control and understand financial choices. Knowledge in this area isn't just about ticking boxes. It's about protecting your assets, your family, and your peace of mind. Thank you so much for joining me, Alex, on Safe Simple Sound today. I really appreciate you investing your time with us. If this episode resonated with you, or if you know someone who might benefit from understanding these requirements, please do share it. And don't forget to check out our show notes. We'll have links and resources there, possibly even a lead on a comprehensive checklist like the one mentioned in the article, to help you start assessing your own situation. Be sure to subscribe to Safe Simple Sound wherever you get your podcasts so you don't miss out on future episodes. We're always aiming to make these important financial topics safe, simple, and sound for you. Until next time, stay informed, stay empowered, and keep making those sound financial choices. This is Alex, signing off.